It's time for Word of the Week. All right. This week we are talking about risk premium. Why is this important to everyone?
Risk premium is important to everyone because it's what lenders build into interest rates to protect themselves from potential losses. It's the added fee baked into your rate because lending money, especially for mortgages, is never guaranteed to go perfectly. I'll ask you really quick, Jennifer, what do you think are a couple top things that would affect that risk premium?
If I'm a buyer, things I'm thinking about are price. I'm thinking about my lifestyle and commute and all of the things that are involved. Do I get to take vacations with my family? Schools for my kids, commutes. There's a lot of things that fall into that landscape.
What I'm talking about is the risk premium that lenders have. Number one is going to be your credit score. Your lower score, you're going to get a higher premium. There's going to be added fees baked into that interest rate because you're a greater risk. Your down payment, your loan to value, how much are you going to put down? Your debt to income, the property type is also a concern to lenders. Income stability. Are you self employed? How long have you been self employed? Are you a W 2 employee? Do you have various amounts of income? How do you structure your tax return? And then obviously, the market conditions are also going to play into that. But that is what risk premium is. And lenders all the time are evaluating those things and many more to say, you got two people wanting to purchase the same house, they are going to get different interest rates because their risk premium, according to that lender, based on all those factors, is going to be different. My best advice is to talk to a mortgage professional that knows exactly how to build a strategy, knows what I'm talking about when I mention all those items, and can guide you in all those facets. How better to position that debt to income? Should I pay something off? A lot of people, I'll talk to them, they'll be like, well, my debt to income, I owe $15,000 to this credit card. And I have to remind them the bank doesn't care how much debt you have. What they care about is what is your monthly outlay correlating to your income. You could owe $500,000 out there in debt. Lender's not going to care. They're going to care what your monthly payments are based on your income. That's all they care about.
Awesome. I love that explanation. This is why we get this risk assessment